call the meeting to order. Roll call, President myself, Fire Trustee Chair Eugene Dugan.
Leah Hayes, Board Trustee.
Steve Arvell, Trustee.
I'm sorry.
He was taking a compliment. You have to
I don't get those very often, so I let him soak in.
stand up and take a bow.
Steve Marvell, trustee.
Walt Garrett, trustee.
Harvey Lewis, trustee.
Barbara Boyd, Purvis Grant Auditor.
Greg Williams, staff.
William Johnston, staff.
All right, online we have our attorney, Bob Klausner.
Very good, Bob. I like the casual look.
We have an agenda before us. Is there a motion to approve the agenda as written?
Second.
All right, there's a motion and a second. Under discussion, all in favor?
Aye.
Any opposed? Okay, the agenda is approved. We have the minutes from the May 24th meeting that I wasn't present. I've reviewed them. Think about the speed. Is there a motion to waive the reading, or would someone want them read?
Move to waive the reading.
There's a motion and a second. All in favor?
Aye.
Any opposed? All right, we are up to our attorney update. Mr. Bob.
Thank you. Just two items that I wanted to cover with you. The first is, I've been with you for 10 years, and I noticed we haven't raised our rates in 10 years. However, my staff has all gotten raises in 10 years. So we are asking for what we think is a pretty modest rate increase. And you'll still be you'll have the lowest rate of anybody that we represent. That's, you know, I have a soft spot for Davisville. In any event, we would ask that you approve the rate increase, because the last time was December of 2013, which is when you hired us. So the increase is from $350 to $385. So we would ask the board to approve an amended professional services agreement.
I move we approve the agreement. That seems reasonable. If that means it'll be another 10 years, Bob, before y'all ask for another rate increase.
You know what? In 10 years, I'll be 80, so sure.
Hey, this is what 80 looks like, Bob, so whatever it's worth.
I'm not holding you to that, but, well, it will be 80. I'm not disputing
All right,
that.
I'll second it on that.
So there was a motion to approve the increase in fees and re-sign the contract, and a second from Leah. Under discussion, I think we've discussed it a little. All in favor?
Aye.
Any opposed? All right, the motion passes unanimously.
Thank you. What I really wanted to discuss, the most important thing, is the implementation of what is now Florida Statute 1.662, which is also known as House Bill 3, when it's working its way through the legislature. You are going to need to change your investment policy statement. And I mean, just to put it in a sort of fine point on it, basically it's going to have to say that all financial decisions, all investment decisions will be based on pecuniary factors, meaning, am I going to make money on this? And a better way to say it is what you're already doing now under Florida's Investor Act, which is in Chapter 518, which is you invest the money for the highest investment return at a reasonable rate of risk. End of discussion. If you were to choose an investment manager that had, or a limited partnership or something, that had an ESG component, as long as the decision is based on the fact that this is going to make more money than a non-ESG component would do, then it's a perfectly permissible investment. The statute, which ironically is in fact ideological, says you're not supposed to use ideological factors in investing, which, if you read the plain language, says you don't do it for or against. What you do is look at, is this going to make money for us? And it really tracks the Department of Labor's private sector rules on ESG, the prior version, not the current version. The prior version is where this language, pecuniary factors, came from. It was taken out of the current DOL ESG factors, which was adopted by the agency in 2022. Everybody's challenging it in one way or another. There are states which are requiring, for example, divestment of fossil fuels. They're getting sued for divesting of fossil fuels, and there are states which requiring that you wake up a company that doesn't like fossil fuels, and they're getting sued. Basically, I think it's a conspiracy of lawyers to make money, which isn't a bad thing in my house, but the Division of Retirement is supposed to engage in rulemaking. We spoke to them, today's Wednesday. We spoke to them Tuesday, and we asked when they're going to get rules, and the answer was sooner rather than later, which is about the most definitive answer that we've got from them on any. The rules are being drafted in the Department of Management Services, not by the Bureau of Local Police and Fire Pensions. So when they get it, we'll get it. And these rules are supposed to be adopted and enforced by December. But if anybody chooses to challenge the rule under the Florida Administrative Procedures Act, which is in Chapter 120, that could stretch out the rulemaking for years. We went over what our draft investment policy language would look like with the division. They said they can't comment on it one way or the other. So we're just going to distribute it next week. And, or maybe even this week. I'll call as soon as we're off here. But it'll at least give you some guidance, and we'll have it on your meeting in July.
No, No, August.
Unless we need
When do you meet again after this?
August.
August, we'll have it on the, available certainly for discussion on the August agenda. It does not affect any contract that you currently have. It only applies to contracts which are entered into after July 1 of this year. The question is whether or not it affects like a re-up of you had money in a limited partnership, version 3, and you decide you want to re-up into version 4 by rolling the money over. Is that a new agreement? That's one of the questions we asked, for which the answer was, that's a really good question. That's about the level of guidance that we got. I don't know that, other than you had some informal discussion before we started today about the city's OPEB fund, I'm not aware of any investments that the pension fund has where the ESG component was the motivating factor in the strategy, as opposed to it may just be a salutary effect. And that's okay. So the rule is you have to do well. And if in doing well you do good, that's okay. If the purpose of your investment is to do good with the hope that you do well, that would be prohibited under the new law. So this is a struggle that your counterparts in California have been going through for about 10 years on these issues. And I do expect that this discussion will still be, a hot topic after the presidential election. We'll probably never hear about it again, but at least for the next year and a half. This
So William, we never added an ESG component to our policy, but there's verbiage now that we have to have in there that we're not going to do it? Is that what
We'll see what Bob's handout says. We may add a reference to it, but that's sort of related to a question I have, Bob, about not this plan, because this board chose not to include any type of restrictions related to ESG or Russia, Belarusian investments. But on the general employees pension plan and the OPEB fund, and also in our operating fund, we have language restricting those industries and countries. Will that need to be removed from those policies?
The restrictions on the countries actually are probably part of the state restrictions. As you know, you can't do business with Syria or Iran or North Korea or used to be prohibited from doing business with Sudan. And then when South Sudan was born, then the State Department lifted the restriction. They may be back on because they're shooting each other again. And there's an anti-Israel boycott statute which came out of Ben and Jerry's not wanting to sell their ice cream in the Israeli-occupied portion of the West Bank of the Jordan, but that was lifted as far as I'm aware. And I think we're just gonna have to play this one by ear. It's unfortunate because you should not be investing. Investing is not a political decision. Investing is a monetary decision. You know, what's best for the plan. So I think, I look at our investment policy as it is now, it's pretty neutral. But I think we're going to need an affirmative statement that really we only look at what it costs, and if there's a non-pecuniary component that is the result of our pecuniary determinations, then it just can't be the other way. You will have to change the OPEB fund if you have a specific direction. You can keep what you have, but you would have to change your policy going forward, because I think this would relate to any, well, it's funny, it certainly is, it's in on 12, it relates to retirement systems. I'm not sure that it relates directly to the OPEB fund, because OPEB funds are not required to be pre-funded. Better financial planners do pre-fund them, but I think that's outside the scope of Chapter 112, Part 7, which is the Florida's Protection of Retirement Systems Act, and an OPEB fund is insurance. So you may or may not have those restrictions there, and I don't know about are there any other boycotts that Gainesville has particularly that I may not be aware of?
They're not boycotts per se, but we've restricted investment in fossil fuels in the operating fund investments. And I thought that this would apply to the operating fund investments based on the language I read, because it also prevents consideration of any ESG factors in purchasing, which is interesting because that's outside the realm of the pension plans altogether.
It is, and that's a separate part of the bill, is doing business with people who don't like oil. I don't, it was like I said, it was a statute that was drafted with a political motive in mind, not necessarily a financial one or an operational one. I don't think this will affect the OPEB fund. It will certainly affect the general employees plan. I'm not sure that it affects the city's operating fund either, because the state has not preempted regulation of that. But in giving you could you send me, William, the investment policy that you have for the city funds?
Sure. Yeah. Well, and I'm sure we'll get further.
I'm not going to charge this fund for that review. I'll discuss that.
And I think we also have Lewis Longman Walker looking at it as well, so
okay.
We'll get some feedback from them also.
All right, I'd be interested in what that. So maybe one of the few times.
Have you had any further clarification on proxy voting? I think that was the main concern I had because of the reporting requirements there.
It's the same thing. I think basically what it is this. If there is a proposal, first of all, you're going to have to keep records. What you voted, what questions were on the proxy statement, and how you voted, which you should have those anyway. You may delegate it. You may continue to delegate it either to a proxy service, or to the manager, or to the consultant. That's really, or you do it yourself. I'm recommending to everybody that unless you've got the staff to sit there and go through the proxies and do the voting, delegate. It's a better use of time and money, in my opinion. So
we currently let the investment managers do the voting.
Then you're going to have to give the investment managers a copy of the statute and say, here it is. And after you have voted your proxies, give us the report. And by the way, we're going to want some kind of acknowledgement from you that you read the statute and to the best of your knowledge and believe you have voted the proxies in accordance with the law. I don't think we're required to go behind them, but to the extent that there are delegatee on this, we do retain some ultimate responsibility, and we're allowed to, but we are allowed to rely on a certification of some kind from them. That's supposed to be in the rules that may or may not come, is what an attestation from the manager or the proxy voter would look like. I mean, companies like ISS already have, 100 different sets of rules on how they're supposed to vote proxies given similar regulations. There are 17 statutes like House Bill 8. Actually 16. Texas didn't pass the one they did. They already have an anti-fossil fuel boycott statute, which was not amended, but they were going to have a House Bill Type 3 with all of this detailed proxy reporting, and they couldn't get it passed in the legislature because two factions within the Republican Party were fighting it. Some thought it was a good idea, and some thought it was terrible. And the reason they didn't pass it is it would have required the teacher retirement system to divest of about $200 billion worth of stuff, and it would have cost the budget of them. So the state would have put additional money into the teacher retirement system solely as a result of that divestment. And there are other states, Arkansas, Oklahoma, New Mexico, keep going, Idaho, and we deal in a number of those states. And proxy voting kind of says, here's what we voted for. The main thing to watch out for in the proxy voting, I think, is if there is a shareholder-driven proposal that talks about business practices or labor relations or gender equity in the boardroom, those sorts of things, even though many would say that those are important for the financial success of the company, the underlying motivation is not money, it's a social goal. Those are the things which the statute would tell you have to vote no. So, and then there's something about if independent directors put it on there, then there's a question as to what management is. So, again, we don't have any direction about what this is supposed to look like. It sounds like what we're going to be reduced to a proxy voting is voting for the board of directors, most of whom we don't know who they are, picking the accountant, which is probably one of 5 firms, and setting the next shareholder meeting. Anything else is probably going to require a no. So, but again, which may or may not be good business. It's one of the things we're going to need advice from the managers. Is this proxy proposal that's on here financially, is this going to drive favorable financials for the company, yes or no? And if the answer is no, then our vote has to be. That's all I can tell you at this point.
All right, Bob. Thank you. Any other?
Thank you, and thank you again for your continued confidence in us, and we look forward to the next 10 years. I will still be working, God willing. I'll look even younger than I do now.
Thank you, Bob. Appreciate it.
Which is why I look much better on the screen. So, hey, take care. Everybody have a good summer, and I will look forward to seeing you in August.
Take care, Bob.
We did approve to do that memo for spouses, Florida, and all that, right?
Yeah, risk
Reference
management
drops.
agreed that it could be used to distribute to employees, and so the board approved payment of it.
All right. I tried reading that case law and it didn't make sense to me. All right, next on the agenda, we have a presentation from First Grade.
That's me. All right, so you've got in front of you the financial statements for the consolidated plan for 2022. We presented a summary of the results of the audit to the City Commission last week, but as you're the governing body for the consolidated plan, you're approving these financial statements. So in the larger stapled package is the actual financial statements. And if you turn to page 1, that's our independent auditor's report. And what this tells you is in the first couple of paragraphs, there is our opinion, is that we issued an unmodified opinion, which is the highest level of assurance that we as auditors can provide. And it means that you can rely on the information that's included in the rest of these financial statements, on the numbers and the note disclosures that are included in here. The rest of the 3 pages is just information about what an audit consists of, what management's responsibilities are versus our responsibilities. I don't normally touch on the numbers, but I do want to point this out, just kind of a continuation of the discussion that Paul was just having, is that you've got on page 4 is your statement of fiduciary net position. You've got a due from City of Gainesville there of $16.9 million, and that is cash that is included in the city's pooled cash and investments. So I'm not an attorney, but maybe something to consider. If you've got net assets that are in another investment or another pooled cash that you guys don't have the control over, because it's being invested on the city side, I don't know if that's going to be pulled in to House Bill 3 at all. Something for consideration there. And normally we see, there are some cash and investments that are being held on the city side that are used to pay contribution or benefits and pay and administrative expenses, but this is a little bit larger number than we typically see.
I would just respond to that by saying the number is large because we didn't have reliable financials for fiscal year '21.
Yeah, it took a while.
And we erred on the side of having more cash available rather than have a negative balance at the end of the fiscal year. That shouldn't happen again, assuming we have good financials going forward. But that was the only reason. It's never been that large before. It should never be that large again.
What's our total cost for the plan every year? Paying out benefits, bulk or?
Well,
Flip to
you've got
page 5.
contributions coming in, you've got benefits going out. They probably have it on the income statement. My recollection is the net generally is about a negative $1 to $1.5 million a month negative cash flow out of the plan. In the past, we allowed that. We did an annual.
So about 15 million.
An annual withdrawal of the investment accounts. Now we're doing it quarterly. But yeah, about 15 million total these days. And remember, contributions used to be higher before we did the pension obligation bond. By doing that bond, the city contributed all those proceeds into the account, thereby reducing its annual contribution amounts considerably by 70% or so. So that's less positive cash flow you have on a monthly basis. But the plan's fully funded.
And it's a fully mature plan, so at this point, you should expect investment earnings to be paying the bulk of the benefits.
Well, and I mean, even regardless of whether it's mature or not, investment returns typically generate between 60 and 70% of the income of any pension plan. And it'll be higher in our case. It'll be probably 80% or more. In a good year.
Yeah, right. Last year that was not the case. If you flip to page 15, this actually gives you the last 9 years of data, if you're interested in looking at it, of what your total pension liability was, your plain fiduciary net position, your contributions, and all your benefit payments and administrative expenses over the past
This
9
is
years.
under note 3.
Page 15 is this table right
Oh.
here. So this is,
This is the added by pages, don't seem to be numbered. Or maybe I have the wrong document.
oh, okay. It's towards the back.
Yeah, on the screen, huh?
Apologies, I don't
Yeah,
know.
that's what I'll do. I'll use the screen. Thank you.
But yeah, the rest of our reports is actually just the last page on there, the last couple of pages on page 19 and 20. And so this is our independent auditor's report on internal control over financial reporting. and on compliance. So, while William is correct, we didn't complete the city's audit for fiscal year '21 until December of '22, and began preliminary field work in January of '22 for the fiscal year '22 audit. So the city continued to have issues, although that has improved tremendously, and I don't expect that to be an issue going forward. On your side, you actually don't have any issues. You don't have any internal control, what we consider significant deficiencies or material weaknesses to report. So your team does a great job with the consolidated plan, as does this log behind me with the on the city's finance side. So that's really it on the two reports that we have on the financial statements that are attached to the financial statements. And then we also have another letter that's called a communication with those charged with governance. And this has just other information that might be relevant to you in assessing the results of our audit. It's not necessarily readily apparent in the financial statements themselves. So some significant audit matters are the qualitative aspects of accounting practices. There are certain policies that management adopts in preparing financial statements, and those policies are included in Note 1 to your financial statements. There's also accounting estimates that are an integral part of your financial statements, such as, for example, the fair value of your financial instruments. Particularly if you had alternative investments that are based on net asset value and not necessarily quoted market prices. So we rely on your investment advisors for those values. Also have a net pension liability that's disclosed in the notes to the financial statements, and that's based on many actuarial assumptions and estimates. And so if there was any change in those estimates, they would significantly affect your financial statements. So for example, you decreased your investment rate of return, your discount rate, from 7.9% to 7.75% this year. And that caused about a $5 million increase in your total pension liability.
It's an expensive assumption.
Yep. Some other matters in this letter: there were no difficulties encountered in performing the audit. There were a few adjustments that we proposed. Management corrected all of those adjustments, none that we considered to be material. No disagreements with management. No other audit findings or issues. So,
I have a question, but I don't know what page number it is.
Yeah, I apologize. I'm not sure why those don't have page numbers.
Back 1, 2, 3 from the end, required supplementary information. What is this a percentage of? And it shows the termination rates for firefighters and police officers at 0 to 5 years of service, 6 to 9. Is that an amount of money that's forfeited or given?
I believe that's actually just a percentage of the total employees, members of the plan.
Like, so from 0 to 5 years, 0.5% of our firefighters separate and leave an actuarial gain in the plan.
Right.
0.5%.
And we can ask Joe to clarify it. Joe Griffin, the actuary, will be up
Later,
next.
right? Okay.
But I believe that's what it
So
indicates.
the police, between 10 and 11 years, they have 2.5% of their staff actually separates, possibly. Maybe? I'll ask you.
That's what it looks like.
I would have thought maybe the 0 to 5 years would be a little higher. Of recent years anyways. This goes all the way till, what does this go through, October?
9/30/22, the financial statements, yeah. These actuarial assumptions are 1 year prior, so these are your 10/1/21 actuarial assumptions.
Oh, this is just 1 year?
I think the termination rates probably don't change very much. I mean, that might be a joke question, but yeah, your actuarial valuation is done every year.
That Bob's probably vested. 10 years you can vest.
So that was it, Mason.
Anybody have any questions? Seeing none, hearing none, anything else? Well, we appreciate all the work, thank you very much.
Yeah, that'll be in order.
I'll move.
Second.
All right, there is a motion to approve the audit as presented, and a second. Under discussion. Except for a bad year last year, I think everything looks like our numbers are good, is what I hear.
Well, I think it's.
You'll see in the vow that according to Joe, we are still fully funded, which we had some concern about given the negative returns last year, but
It's tracking better this year, right? All
Gotta
right.
cover the other funding, so.
All in favor of accepting the audit, say aye.
Aye.
Any opposed? All right, motion passes. Thank you very much.
Thank you.
Appreciate it.
Say hello to Leah Emig, if she's still working.
No, she retired a year or two ago.
Oh,
so,
good.
yeah.
Next on the agenda, is Joe up there?
Joe's on.
okay.
We have Foster and Foster.
Can you guys hear me okay?
We can.
Awesome. Well, I wish I was there in person, but I just got back from the beach, so I wasn't able to make it there. So I appreciate you accommodating the presentation via Zoom. I'm presenting the October 1, 2022 valuation, which actually determines the contributions for fiscal 2024, which is coming up October 1 through September 30th of 2024. Just to remind the board, the purpose of the valuation is to take an annual snapshot of the plan. So we collect information on every member that's in the plan. We get the asset information from your investment consultant and the auditor. And we look at those demographics of the plan, and we project out benefits out of the plan for the next 100 years. We did count those back to the snapshot date as of October 1, 2022 to come up with the liabilities. When we're discounting that, we use the 7.75% annual return that we moved to last year. We compare those liabilities to the assets, and then we apply the rules of Chapter 112 to come up with the contribution requirements. So if you wouldn't mind flipping to the first page of data, I'll walk you through one more slide. There you go. I'll walk you through kind of how the data and membership counts have changed year over year. You'll see that the active police officers, these are police officers who are currently employed and earning benefits in the fund, has decreased to 218 from 226 a year ago, while the firefighters have actually gone up from 163 active firefighters to 172 as of October 1, 2022. The third bar, the darker blue bar, represents members that have separated service with the city and are vested in their pension but have not hit the proper age to draw. We got 38 of those members. We've got 25 police officers and firefighters currently in the drop as of October 1, 2022. And then there's 454 members who are drawing a pension from the fund, whether it's a retiree, a beneficiary, or a public safety officer who qualified for disability.
Sorry.
Can you flip to the next slide, please?
The deferred, the blue is just not vested active, or what? No,
Vested, but not eligible yet.
that's the
And
dark.
the dark blue are
Oh, police and fire.
members who left employment and are due a pension in the future.
So the number went down because a couple of them actually cashed out there,
A few people became eligible for retirement.
or they were eligible.
Yes. All right. This shows you the average salary for the active members, and so you'll see the firefighters' average salary went up to $73,465, and the police officers' average went up from $69,000 under $70,000 to $74,174. Salary increases were slightly higher than expected. You'll see later on the slide that created an extra loss to the fund. If you look to the next slide. So this is an average annual benefit that's being drawn from the pension fund each year, and so you'll see that the firefighters are drawing an average pension of $43,620, where the police officers are drawing slightly lower pensions, $38,905. We'd expect that these averages will climb for two reasons. One, police officers and firefighters retiring today were making a lot more than police officers and firefighters 20, 30 years ago, and also the plan pays a COLA for certain members that qualify. So we kind of expect the averages will go up over time.
No. Joe,
Yeah.
and maybe it's just because we've always done it this way. I'm not a big fan of average annual benefit because, outliers can impact a average much more so than using a median. Is there a reason you all go with average versus median?
No, we can show median if that's a more meaningful statistic for you. We've always kind of shown averages, but to your point, the median is the 50th percentile, which means that half would be making more and half would be making less. And so some of our clients prefer a median. We certainly can make that change if you prefer, or we can show both. Actually.
Let's do both. But both is my preference because I think you get a little bit of information from both.
Or granular.
Yeah. I'm more of a
That's
median.
that's an easy add. I can add that to it and send it back out after the meeting.
Thanks, Joe.
Sure, no problem. Next slide. Okay, so we're coming off some pretty good years of return, as you know, and the pension obligation bond proceeds got deposited right before we enjoyed that 23% return in fiscal 2021. And you can see that this past year was not great. We had a negative 16.08. And keep in mind that it's all relative to the 775. So when we have a 23% return, the gain is what's above the 775. When you have a negative return, it's a bit exacerbated because now you've got, essentially a minus, 23% loss. So just keep in mind that this is all relative to the 775. Two things that we changed last year in the valuation. One was we set the actuarial value of assets to the market and moved to a preferred smoothing method. And we also lowered the discount rate or the investment rate of return assumption from 7.9 to 7.75. So even though we have a minus 16% return, we're only reflecting a minus 0.48% return on the actuarial value because we're smoothing out the impact of the minus 16% over 5 years. In absence of gains, future gains, we'll see the contribution rates potentially go up and the funded status come down. Understand that the fund is having a good year so far, but remember, it's all going to be relative to where we sit on October 1st of this year. So this just shows you the market value. Back in, I think it was 2012 or 2013, the board asked us to start tracking the assets separately between the police and fire. I think that was mainly for negotiation purposes. And so you'll see the breakdown of the assets. We saw from Purvis Gray's report that we're at $277.9 million in total. The breakdown between police and fire is $165 million for police and $112.9 million. You can kind of see how those numbers have changed over the past 5 years. If you look at the next slide, you'll see the actuarial value. The actuarial value smooths out gains and losses. As I said, it's kind of hard to compare the past to this most recent year because we reset to the market last year. But you can see that even though we have 277.9 million in market value, when we calculate the contribution requirements, we're using 332.8 million. And so you'll see a very smooth progression of this actuarial value of assets over the next 5 years as we reflect gains and losses in the future. So when we calculate these contributions, we're pretending like we have $332.8 million in the bank as of this snapshot date. So here's a breakdown of gains and losses year over year. So the biggest one is the investment loss. It increased the unfunded liability by $16.6 million. As I mentioned earlier, salary increases were a little higher than expected. That added about $2.7 million to the liability. And the interesting thing that happened this year, and this doesn't happen all that often, is that the actual asset corridor kicked in. So we used a smooth 5-year gain. We smoothed out gains and losses over a 5-year period, but there's a corridor that's put around the market value, so you don't get too far away from the market value, a 20% corridor. So our actual value of assets is actually 120% of the market value this year. So it's added an additional $11.3 million in loss. So if you add those two together, you can see the majority of the gain and loss is tied to the asset loss for this year. Almost all of the 28.6 million when you add the 15.6 to the 11.3. So not great news, but at the end of the day, you started in fiscal 2021 at 109% funded, and your plan has dropped to 101% funded. So you're still over 100% funded, and if we continue to have the market returns that we've seen so far in fiscal 2023, that could stay above 100 at the end of the year. But if you look at the pie to the left, the $359.1 million is the present value of all future benefits. So in theory, if we had $369 million in the bank today, and we met our assumptions, including our 7.75% return, we wouldn't need to put another dollar into the fund, not from the city, not from the state, and not from the members. But that's not how we fund pensions. We accrue it over the member's career. So our accrued liability is $329.1 million. That's the green slice of the pie, which means that there's another $40 million in expected future accruals or contributions to be paid in the future for benefits that are going to be earned in future years. You'll see that the firefighters funded percentage is slightly higher at 102%, and the police officers in an aggregate were at 101.1%. If we did not use asset smoothing and we looked at it on a market basis, the plan would be about 85% funded as of this snapshot date, or 84.4%. But again, we don't value on a market basis. If we did, the contributions would be extremely volatile. The funded percentage would be extremely volatile. This is a long-term obligation of the city, so we smooth out any short-term volatility. Okay, so here's the required contribution for 2023 and 2020 compared to 2024. And you'll see that the minimum required is the normal cost plus the administrative expenses. Because we're over 100% funded, there's no amortization of an unfunded liability. So the contribution went from 5.29 million up to 5.48 million, or 19.3% payroll. And you can see the breakdown between the members, what we expect to get from the state, and what's remaining from the city. So the members are estimated to contribute about 2.3 million. The 1.1 million coming in from the state. Of course, anything above that 1.1 million goes to the share plans currently, and then the expected city contribution is just above 2 million, or 7.13%. That is not a typo, by the way. Your contribution from last year and this year is exactly the same as a percent of payroll. Of course, your payroll went up, so the dollar amount went up. but it remains the same as payroll. In the next couple of slides, we break it down between police and fire. So the firefighters, you can see that the contribution went down as a percent of payroll, even though the dollar went up to 2.4 million. Expected member contributions, the firefighters contribute 9%, so that's about $1.1 million. The state offset of $580,919, or 4.67% of payroll, and then, sorry, my screen went blank because inactivity. Okay, and then so the expected city contribution went up from 640,000 to 715, or 5.76% payroll. If you look at the police officers on the next page, you'll see that their contribution went down as a percent of payroll. For just over $3 million. The expected member contributions, remember the police officers contribute 7.5%. Back in the last couple collective bargaining agreements, you may recall the firefighters contributed more but kept the cost of living adjustments the same, where the police officers kept the contribution at 7.5%, but negotiated lower cost of living adjustments on the pension. But you'll see that the 7.5% is about $1.2 million. The expected state contribution, $558,361. So the net city contribution is $1.3 million, or 8.21% of payroll. That really concludes my presentation of the results. Happy to answer any questions. We are currently working on looking at all of the assumptions used in the valuation, including the termination rates that you guys were looking at in the audit report. And we'll be presenting that at a future board meeting to recommend any changes to the current assumption.
It's probably more finance than a actuary question, but so last year fiscally, when we had a down year, the plan ends up making those bond interest payments, right?
The city makes these.
City made, so
That's
the
why-
city's cost last year was 3.5% of 40 million plus the 5.9.
Exactly.
So that's where we ended up on the bond.
Plus the original debt service on the 2003 bonds. Because we did a
How
bond,
far out did they go? Payment?
the 40 years.
40?
30.
Yeah, 30.
2003's last payments in 2033.
Okay.
Oh, good. What was the interest then?
A little over
Should have been lower, right? Oh, no, higher.
Yeah. It was good at the time, but
But yet, the spread between the assumed rate of return are basically about the same. We had a higher
Assumed rate, it was like 9%.
by another 100 basis points. Was it way back in 2003, like 875 or something like that? Or
well,
was it 8.5?
if I remember, the way it worked was the police and fire plan lowered the assumption rate just before that bond issue in 2003 was done, but the general pension didn't. And so the police and fire plan got actually more of the proceeds from the debt issue than the general pension did, because they created a higher unfunded liability.
And that was some of my question too, how the bond issue fit in all this.
The city makes the debt service, so that the idea is that you create an arbitrage by paying less on the debt service than you would making contributions.
Right.
And you earn more on the proceeds that you put into the pension plan
So
than
as
you're
long as you
paying on
covered
the debt.
what the 2.75, whatever number was.
It's a little over 3 all in.
Hey, Joe, I got one last, so on your slide here, the way I understood the funded percentage, if we didn't use any averaging or smoothing and not another dollar went in, our plan is 85% on the dollar, basically?
Market value.
It's, yeah, on a market value basis, you're at 84.4% today.
Mm-hmm.
So if we didn't smooth the actual value of gains and losses and we just used market, you'd have a fairly sizable unfunded liability payment
Right.
to pay off the $50 million difference between the market and the actuarial.
And that's directly related to the return. We were down a little over 16%.
Right.
And in the previous year, the market value, we were fully funded. We were like at 101 or 102 on market value. This year, so far we're up and, not enough to make up the whole difference, but we'll see what it looks like on.
You had a strong last quarter, right?
Well, summers aren't typically great, but we'll see if we can't hold on to what we gained.
All right, is there any other questions for Joe? We need to move to accept the actuary?
I think you need to approve the draft with
Oh.
the recommendation to add the median benefits, and then Joe can finalize it and submit it to the state.
All right, is there a motion to approve the draft with the addition of the median?
Yep, I'll make that motion.
There's a motion, Harvey, a second?
Sure.
All right, under discussion?
So this is for our purposes, the presentation where the graphs were, not
So you didn't want it
necessarily a
in-
filing
in
to
the-
the state. I
Okay.
mean, yeah, you know what I mean?
Good
Okay.
point, yeah.
Yeah. I
Just
did-
approve the draft then.
As amended.
Amended, it's not, motion's amended and still seconded to approve the draft.
And while we're still on the topic, just from my own understanding, the 84.4% of funded value of our pension plans is a little higher. I mean, my recollection is 20 years old, so forgive me, but a little higher than the 80% people used to shoot for.
Right.
And so.
That's what I was always told years ago.
On balance, this is a very good,
Yeah.
but
Funded ratios are but a single measure,
Yeah.
and they're a measure of a plan on a single point in
Yes.
time. I think if you're really interested, you go on the division's site and pull down their data of all and look at employer cost of retirement. So to me, that is a better benchmark on plan design and benefit levels than just a single point in time. People get fixated on the funding
well,
status,
precisely that.
but that's just on
no,
September 30th.
But that's people, you're right, people do get fixated, that was the reason for mentioning, but our contribution is what, 18% roughly, something like that?
Well,
How
total,
much was?
between the two would have been, and the state would be 19,
19,
right?
yeah.
So we're
But the city's portion is, I mean, that's what the city's concerned with, and so you're looking at 7%.
Yeah, right.
Prior to doing the pension obligation bond issue, that rate was in the low to mid 20s
Yeah.
and increasing.
Yeah, it was anywhere from 15 to 21, 23 maybe.
Is that
And that was before the salary increases and everything, because that kind of all hit at the same time. So you would have seen that jump into the mid 20s probably.
Traditionally, as an employer, and there's not a lot to find that in the plans, I mean, there's not too many of them anyways, but
So 400 in the state of Florida alone.
I was about to ask, what's FRS?
yeah, that'll dwindle down in the next decade. Wasn't it traditionally 1.5 to two times what an employee contributes, just about, if you look at most plans?
Probably. Well, it depends on the plan. I mean, there are plans in South Florida that, and Joe, you probably see some of these. I know the employer rates for some of those plans are 40%, 50% of payroll.
Wow,
Even higher, some are even higher than that.
But, those, I would argue those aren't really well designed and run plans, or maybe the benefits are a little bit rich,
So the employee's not putting much in.
not nearly half or whatever.
Right.
I think what a lot of people compare it to is what would a defined contribution, what would that plan look like? And, for the city's 401, the employee puts in 5%, the city puts in 10%. But that's rich compared to a lot of
Yeah,
defined
that's the
contributions.
problem. Most places, 0
It's
to 5
1
years,
to 1.
up
It's
to
5%,
3% match it.
Yeah, something like that.
If everyone was gonna do 10% out of the gate, they probably would work better, and you invest properly.
And a lot of the difference, obviously,
The 23% was with 5 years smoothing also?
I'm sorry.
The 23% city contribution, was that with 5 years smoothing also?
Yes.
Wow.
but a
Yeah,
lot
I
of
think
the,
it was around it, but it wasn't all up there for too many years, I don't think, looking back. I thought it was 19%,
It was going up by
21,
1% or 2 a year.
even as low as 15 maybe.
For a while.
It was steady up.
Yeah. And part of that
But
was,
William,
yeah,
couple things about FRF. They're at 82% funded. Now they're a July 1 valuation, so the snapshot's a little bit different. They've also lowered their investment rate of return assumption down to 6.8%. So those are a couple differences between your plan and FRF. I mean, you're, higher funded, different point in time, but you're also assuming we're gonna return 7.75 versus 6.8%.
And FRS has a much higher employer contribution rate.
Well, high risk, I think,
Well, I'm
is
just gonna ask you-
25%.
So,
Yeah, it used to be higher.
So, Joe, FRS reports a blended funding status number, don't they? They don't look at each
okay.
plan separately and say, our high-risk plan is X,
Well, they're all the same investments, aren't
They're
they?
all the same plan, yeah. Contributions
no,
are
contributions are different.
Yeah.
And you can tell by the
Yeah.
UAL component of it that FRS is not completely transparent about where their liabilities lie, okay? Because that would mean they'd have to say, man, our elected officials
I was gonna
are
say,
way underfunded,
the
okay?
short-term ones are really
Yeah.
underfunded.
When I was working, they had a whole bunch of judges in, no prior contribution, and
Well,
it skyrocketed.
Speaking of funding rates, are we okay with 175, 185 at 7.75?
Well, the state always, they like to see a lower rate, so their recommendation is always that you should lower your rate. It really varies by year. We just did an asset allocation study on the general employees pension plan, and each consultant has their own capital market assumptions that they use. On the general pension plan, the consultant is ANDCO, and they use the JP Morgan capital asset market assumptions, which I tend to think are pretty good standards to use. Based on that plan's asset allocation, those assumptions that just came out recently from JP Morgan predict a 10% return for the next year. And that's because asset values had gone down so much that they're predicting a recovery across almost all asset classes. Having said all that, this plan has continued to, even through some of the most recent volatile and down markets, return over 8%, close to 9% annualized. And our argument for the state is, you can recommend that we go lower, but we've proven that we've earned more than where we're at already.
My concern was when you hear they can say, well, we're less than 7, why are you almost 8?
Well, a lot of plans are lower, have lower return assumptions in the state, but they also have much different asset allocations.
They want us to pay more money.
Yes, if you're gonna deleverage your risk based on that lowered assumption, it makes sense. But if you're just lowering the assumption but not changing your investment policies associated with that assumption, you are really just sucking cash from the people who fund this plan beyond what you need.
Well, I only bring it up to just avoid the 175, 185 nightmare again.
Well, the issue we had with the division retirement, where we went through and it started an administrative hearing process, it wasn't related to our investment return assumption. It was related to the payroll growth rate assumption. And they argued that we were using a rate higher than the last 10-year average, which the Florida statute actually says you can use. But there's some language in the statute about reasonableness, and although we thought it was reasonable, the Division of Retirement, their position was that it had to be reasonable to their actuaries. And despite us believing that it was reasonable, and that being borne out in the recent payroll growth rates that we've seen over the past couple of years, by the way, they still argued that it was too high. But we did the pension obligation bond issue, and that sort of negated that whole argument. Because the state was saying we had not put in enough money, so when we did the pension obligation bond, we basically put in proceeds.
When that all started, Harvey, we were pitching a plan to ramp it down, or, there was no feedback from the state. They were a mess over there. There was a lot of turnaround, so we didn't get, and then at the end, they dropped the ball, like right right at the end of the game, they're like, oh, well, now you're not gonna get money. We're like, well, you didn't. Unless we were, as far as I knew, we weren't hearing anything back from them.
The die whimper, not a bang.
Bob was we were in an administrative
Originally, I'm
hearing
talking way back.
process.
I'm talking about before we lowered it, like 4 years ago, when the growth assumption started.
Right.
Before the bond and stuff.
The payroll growth assumption only has an impact when you're funding an unamortized accrued liability. All right? You can eliminate a payroll growth assumption by using a straight line amortization of that liability so that it's an even level payment over time versus an accelerated payment based on that payroll growth. So that's why that has an impact with the state, is you're pushing out your liability payments based on a growth assumption that will never occur. So they have a valid position on that, but
Well,
and I'm not saying that that's what we should do, is just go to a straight line amortization, because that would not be standard practice, right, Joe?
Correct. I mean, we have plans that have gone to straight line amortization with no increase, but most cities prefer to keep their contribution level as a percent of payroll, which is kind of how the normal cost is calculated. So it just goes to the point of when you have an unfunded liability payment, that would also increase with payroll. But fortunately for us right now, the payroll growth assumption doesn't mean anything in our contribution requirements because we don't have an unfunded liability payment. But could if we don't make up for some of the losses we had last year.
Yeah, well, I think I don't think we voted yet, did we? So there was a motion and a second to accept the actuarial val draft.
Oh, that's right. But we voted, but we had to amend
Okay.
they don't have to include the median in the final draft, just. Yeah.
All in favor?
Aye.
Any opposed? All right, motion passes. Thank you, Joe.
Thanks, Joe.
Thank you. I appreciate it.
And this really is a totally different language than English.
All right, next up, do we have the presentation by Aries? Am I saying that right?
yes, I believe Aries is on.
Hey, good morning, gentlemen. I can't really see the room, but hope everyone's doing well. I'll make this presentation concise and brief, and hope to answer any questions you may have at the end. If you can turn to page 6, please. Just a quick overview of the firm. Aries is a global alternative asset manager, around $360 billion at present, with its sole roots in credit. We started as a local credit shop, trading syndicated loans and bonds, and have grown tremendously since our origins in 1997. As you can see, credit is the largest aspect of our firm, over $235 billion to date. Our private equity arm is around $35 billion, which was also key to the start of the firm. But we've also recently added real assets, including real estate debt, and infrastructure, and also secondaries within the past 10 years. This has helped us grow to the size that we are, but also provided us a meaningful advantage by the scale and breadth of our platform to gather differentiated information for our clients. We turn to the next page. Apologies, one more. Sorry about that. So this is a little deeper dive into the Aries Credit Group. It's a $235 billion balance sheet, what we call a solution provider to our clients. The strategies we span within the group, syndicated loans and high yield bonds, particularly important today, but also alternative credit such as CLO, debt investing, ABS, and all the way up to direct lending and project finance. We have a deep team, and like I said before, tons of sponsor relationships. This provides us with an extreme advantage over our peers to get differentiated information, industry knowledge that helps us drive our investment processes further. My name is, apologies, I didn't introduce anyone on the call, I just kind of went right into it. My name is Brian Napoli, the product manager for Aries High Yield. And with me on the call today, we have Chris Mathewson and Kapil Singh, both co-portfolio managers of the high yield asset class. Apologies for my rudeness, but I'll go ahead and kick this over to Kapil Singh. You can dive into the Aries liquid credit group.
Hi all, I'm Kapil Singh, as Ryan said. Been with Aries since 2018 and been in the U.S. finance industry for 30 years, 1993. If we can turn to 10, thank you. So as this shows, our group, specifically the Global Liquid Credit Group, manages about $45 billion in assets. We manage $9.5 billion of high yield globally within that as part of the larger Aries organization. So we really think of ourselves as a nimble boutique manager within a much larger infrastructure and having sort of the benefits of those resources that we can bring to bear. If we can skip to, actually, just go to 11 for a second. This basically just shows all the different asset classes that Aries manages, and we really do believe this is a big advantage for us. We call it power of the platform, and we live it. Our analysts are talking to their counterparts in all these different groups to just collect as many data points and get as much of an edge on industries and companies, regional management teams, which really helps drive our diligence. And then on 12, you can look there. This really just shows you the significant resource allocation that Aries devotes to the high yield and leveraged loan asset classes. We have 11 PMs across the U.S., LA, New York, St. Louis, and then also in London, so we cover all developed markets. We have 26 fundamental analysts across LA and London. And the senior analysts, as you can see sort of in the middle, have PM level experience, more than 2 decades for most of them. And really what they're doing is they're using their deep industry knowledge and management contacts to really make sure that we're invested in the best ideas within their industry sectors. And then they have mid-level and junior level analysts as well. And then you can see the top part there is in the US and then Europe. Below that, we also have what really we think gives us a strong edge versus at least places I've been before is the quantitative risk and research group, which is kind of in the middle right. That's a group of, they really do a lot of quantitative research and sort of algorithms, both top down and bottom up, to try to give us a real framework to drive our investment processes depending on economic changes that are happening, predict recessions, default rates, and then we take our bottom-up fundamental research and sort of marry those two things, so we don't really we don't get wedded to their results, but it's a great forecasting tool for us to have in the background, and it does drive a lot of industry level changes as well as security level changes. The other parts of the organization there, we have traders, the bottom and product management that span the globe as well to give us sort of real-time data from all of the developed markets, as I talked about before. And then we have the help of, on the top right, our alternative credit team, which really just gives us a lot of information on, for example, CLO creation, which drives a lot of
loan universe, but then leads into high yield as well, as a lot of the issuers are, there's an overlap between the two issuers. And then we have our distress group, which is, we work with on investments when we're doing more stressy type investments to try to get capital appreciation. If you go to 14, this just, lays out very simply our investment philosophy, which I won't belabor, but basically bottom-up diligence drives our investment decisions, and again, we marry that with the top-down, but it's all about downside management and downside protection and capital preservation. We know that debt is a asymmetric asset class with par or par plus upside, and so sort of unlimited downside. So we manage that way. If we can flip to 15. We really look at things, like I said, both top-down and bottom-up. So top-down, we meet monthly for our global asset allocation committee meeting, which the quant team runs, the quant team I mentioned before. We go through really, what's happening across the globe. We talk about whether Europe or the U.S. looks better from a relative value standpoint, loans or high yield look better. What rate regime we're in, obviously that's been very topical. Lately it's gone, flipped from rate drops during COVID to rate rises post that, and then now we're in sort of a period of kind of a holding pattern period. And then we get into industry level discussions as well. We talk about duration. We don't target duration per se. We don't try to predict rates, but we do tilt. Depending on what we think the rate regime looks like. And then bottom up, that's really where obviously the rubber meets the road. We meet multiple times a week in the investment committee. There's that in the middle. You have a very hard to read our checklist and research report that the analysts provide for us. And we go through, all sorts of data to really get into liquidity, credit quality, earnings, the Porter's five forces of where a company sits in its industry, et cetera. And then monitoring on the right, we, obviously we're seeing real-time data all the time through Bloomberg chats, through email, but also we do formal monthly report to really kind of hold the PM's feet to the fire in terms of what we decide to do at the asset allocation committee. Are we doing it, and what's driving returns? Where are our risks really sitting, and do we want them sitting there? We can go to 16. That's our investment process. So, from idea generation, analysts who are obviously closest to their companies do 90% of the idea generation, and then at times the quant group will give us top-down ideas if there are parts of the high yield market that look rich or cheap. We will ask for specific ideas within certain segments. For example, higher quality triple Cs or double Bs if they look cheap at the time. And then at investment committee, they're on the sort of bottom right. We go through, as I said, all the various metrics that we're constantly tracking to make sure that our investments are doing what we think they're supposed to do and getting us the appropriate returns. In terms of portfolio construction, we are really looking for core holdings to give us steady income, and then we layer on top of that higher beta, stressier type investments or discounted investments for capital appreciation or even higher income. And then we do some off-benchmark investments as well, including loans and investment grade to sort of tweak either duration or if we like things, if we think certain investment grade names that look cheap if they're trading like high yield names, and we can underwrite them as we do our normal high yield names, and we like putting those into the portfolio as well. And then from a risk management standpoint, we do daily monitoring. We get weekly stats packs, obviously, that give us information about exactly, again, where our risks are sitting and how to optimize our portfolios. And then in terms of credit monitoring and exiting investments, we get very quick notifications. We are very active asset managers, so we are changing portfolios around, swapping as needed. And as with most leveraged finance, places exiting the holdings is much easier than putting the holding in because we want to be the first sale. Generally, that's the best sale.
I'll jump in if we could go to single
We'll
name.
go to now. Our positioning that Chris will talk about.
Hi, my name's Chris Mathewson. I'm the other high yield portfolio manager. I've been at Ares now for almost 17 years, so quite a long time. At the firm, started out as an analyst and came to PM a little over 5 years ago. So this slide is just a snapshot of the portfolio. As of April 30th, we've actually made some moves over the last 5-6 weeks, which I can kind of touch on. But if you look to the top left, you can see the number of issuers in the portfolio at 145 versus the benchmark at 974. So we own about 15% of the market. We're bottomed up credit pickers. As Kapil said, we're not trying to recreate an index. We're going to put our quote unquote best ideas in this portfolio, but obviously do it in kind of a diversified way. Looking at that, our average position size is called 60 to 70 basis points per name, and we size things based on our conviction level, our ability to project cash flows, and kind of the relative value of that particular investment opportunity. From a risk perspective, you can see our weighted average OAS is 488 versus 434 for the index. So we're about 50 basis points, a little over 50 basis points higher than the index, so we are slightly overweight risk. We have taken that down over the last month as triple Cs have continued to rally. Risk has continued to rally. We've taken down triple Cs almost 200 basis points in the last month. So we were, call it 400 basis points if you look to the middle. We were 14.2 triple Cs versus 10.4. We've taken that down about 200 basis points. So into this rally. So our OAS is now only about 30 basis points overweight. And we like our position here. We're not continuing to de-risk at this point. From a market price perspective, we do like discount to par. So you can see our market price is 89 versus 90.5 for the benchmark. We've done that via a couple of things. Layered in some of the stressier names that we really like, and we've also been buying higher quality, both double Bs as well as some investment grade. Slightly longer duration than the index, but trading, call it 80 cents on the dollar. There's just a lot of optionality when you're buying a bond at that discount to par. A lot of good things could happen. The company could get acquired, it could get upgraded to investment grade if it's below investment grade. So that has been a focus area for us. You can see our yield to worst at 8.76 versus 8.37 for the index. Again, slightly overweight risk. We like current income. As you can see, we're 6.57 versus 6.56, so we are slightly overweight there versus the benchmark. Last couple of things I'll note. Duration, Kapil mentioned that we're not really trying to take a big view one way or the other. In the portfolio, we're 3.57 versus 3.62, so we're right on top of the benchmark. Though our fixed portion is higher by about 25 basis points, and that's some of that longer dated, lower dollar price, higher quality paper that we put in the portfolio that we're balancing against the 7.5% weighting to loans. So we're trying to pick up some of that convexity in the portfolio, move kind of higher quality, but not trying to take a big view duration-wise, and so we're balancing that out with loans. From an industry perspective, I'll just kind of touch, there's a lot going on here, but we're generally speaking overweight more defensive sectors such as utilities, technology, and slightly overweight insurance, which are more stable businesses. Where I will say we're taking kind of a cyclical bet is in energy. So you can see we're 470 basis points overweight there. That is primarily in midstream. So we're not taking direct commodity exposure like you would in an E&P. These are the pipelines that are moving moving the commodities, and we just believe in the value of the infrastructure, particularly after what we just watched happen in Europe. We think that asset valuations are going to continue to move higher in that sector as energy infrastructure and security are increasingly important. And the other thing I would note is our overweight in basic industry. That's a lot of different sectors, but the real one here to note is our building products overweight. And it's kind of been a contrarian call versus last year when everybody was sell anything that touched housing, whether it's the actual housing market or anything that sells into it, both repair and remodel and new build. We took the other side, and it's really a dividend this year from a performance perspective, because these companies have continued to perform well. They had banner years last year, slowing down this year due to the increase in rates. But if you kind of look at equity valuations across those those sectors, they're hitting all-time highs, and I think that the high-end market is finally starting to catch up on that. From an underweight perspective, I'll just highlight, we underweight some global cyclicals such as automotive. Leisure we're really underweight on valuation, but also on the cruise line. We really only have one name there, and that's been a pretty big industry over the last few years as they were funding cash burns from during COVID. And we just don't think a lot of those balance sheets work, but so that's why we're underweight there. And then telecom is the other thing I'll note, and that's been one of the worst performing sectors in high yield. The market is starting to question their heavy CapEx spend, which they've always said is for growth, building out fiber networks to deliver high-speed internet to the home and business. But it's more and more looking like that's really just defensive and kind of maintenance CapEx that's required to compete against, whether it's satellite, mobile, cable. So you've seen industry valuations getting hard there, and that's flowing through to bond trade prices. So it's been good being underweight there. Maybe moving to slide 19 now, which is performance. So I'll first start, our since inception performance and the 5-year, which we like looking at things over the long term, and we're outperforming by 70 basis points since inception, 50 basis points a year over the 5-year. Our 1-year performance is a bit disappointing. We had a tough Q4 of last year, and we had a really good Q1 of last year that kind of rolled off, so there's a little bit of timing there. There were a couple companies that reported weak earnings, and that drove trading prices lower for those securities. What I will say, pull it up, this year to date was where we showed underperforming the benchmark. That was through April. We've had a really good May and June, and we obviously couldn't put it in the presentation for compliance purposes, but just to kind of give you real time, this was showing that we were underperforming by about 35 basis points. We're now outperforming in the fund year to date by 26 basis points through Friday, So had a really good last 6 weeks. So I just wanted to highlight that. We obviously pay attention to near dated performance, but we are more focused on longer term performance through multiple cycles. With that, we're happy to answer any questions should you have any.
William, Greg, you guys have any?
No.
I'm not seeing or hearing any. Thank you for the presentation. Is that everyone?
Well, I have a question, I guess. Trying to find the page now. It's a very busy page. I think it was your three-pronged approach to investment process governance. I was impressed with the amount of work that must have gone into to develop this and the analysis within the organization. What amount, level, or activity of artificial intelligence might you use in the future to develop something like this, to gather the data that you obviously have, to assemble it and to spit it out in terms that might help you make a few more dollars?
Very topical question. We don't use AI at the moment, but across the PM team as well as with our quant team, we have been talking about this a lot. We don't want to jump into a technology because we feel really good about our deep research that gets into company trends that we don't think get uncovered by AI at this point. We don't think AI is at that stage, but our top-down, the algorithms that are driving our top-down kind of framework and background. We have two people, Ruben Valverde and Jonathan Maneri, who are very senior people on the quant team that are constantly looking at how to use it. So I don't have a good answer in terms of specifically how we'll use it, but it will be to augment the top-down portion. And I do think it will be sooner rather than later that we'll start to use some degree of AI, let's say within the next year.
Yeah, I would say the first thing is the first and most likely use in the near term is going through and looking for trends across earnings transcripts and earnings reports across industries. Right. I think that's going to be the first thing, and it's really going to be additive to our team. I think the bigger question longer term is, one, what sort of disruption does this create within financial services, but then also there's going to be certain subsets of the economy that are going to be disproportionately impacted both from a positive as well as a negative. So that I think is I'm not going to call it longer term, it's probably medium term, and we're trying to ascertain kind of the impacts there as it's obviously moving pretty quickly. I mean, it's wild to see how much improvement you've seen in AI in just the last 6 weeks, 2 months. So it's obviously something we're really paying attention to.
Yeah, I mean, we did pass on a secondary idea recently because we think their business is going to be hurt by AI. So it's definitely in our conversation.
Thank you. I tell people all the time, I'm glad I'm retired. So.
Any other questions? All right, Aries, thank you very much. Appreciate it.
Thank you.
Thank you.
Next on the agenda, presentation from Cole and Zach, Willis Tower Watson.
Hey everyone, morning.
Morning.
You want to flip to slide 4, that's perfect, yeah. So I'll give a quick update on capital markets through April, and then we'll look at performance as well through April. And that'll be it for us today. So with that, first 4 months of the year, in the top left-hand corner of the screen, you can see that equity markets with the S&P 500 have returned almost 10%. So pretty strong performance year to date through April. They were up almost 3% for the last 3 months. Small cap stocks have done decently worse. Pretty flat performance through April with economic concerns over recession there, affecting the small cap stocks a little bit more than their larger counterparts. And then you can see that international stocks and emerging markets up about 11.5% and 2.8% respectively. On the right-hand side of the page, you can see fixed income returns. So far year to date, we've seen pretty strong returns there as yields have come down ever so slightly across the yield curve. That has benefited the returns for long government, long credit, high yield, et cetera. So pretty strong returns from both equity and fixed income markets. And then just a few inflation figures or economic figures in the bottom left-hand corner. You can see that inflation is now under 5%. So we've seen that come down pretty significantly over the last couple of years, although well above the Federal Reserve's target of 2%. So still very much kind of in focus from the Federal Reserve to continue to bring that number down lower and lower. With that, the Federal Reserve did pause their interest rate hikes at the most recent meeting last week. But they indicated that there would likely be more interest rate hikes later this year. And what's priced into the market right now is that they will raise interest rates 25 basis points at their next meeting in July. So continuing to remain data dependent there, pausing for the time being, but likely to raise again in the near future. With that, economic growth is positive, 1.1% in the first quarter, and unemployment continues to tick down ever so slightly, about 3.4% currently. So besides inflation, pretty strong economic indicators. Last thing I'll mention on this slide is through yesterday, equity markets have returned about 16% year to date, with a lot of that performance coming this month so far in June. So May was a positive month, ever so slightly, about 50 basis points positive. We're up about 6% so far in June, so that's leading us to about 16% year-to-date return for equity markets through yesterday. So, the markets are pricing in, a soft landing and optimistic expectations that the Federal Reserve will get inflation kind of under wraps. Anything there? So looking at performance, also the first 4 months of the year, you can see the top purple line up there, the total plan year to date has returned 4.5%, matching the benchmark of 4.5%. Fiscal year to date, so through last September, the plan has returned 12.3%, and that's pretty well above the benchmark of 10.8%. So we saw in the Foster presentation, obviously 2022 was a pretty negative year, but we've seen that rebound pretty significantly so far fiscal year to date. And as mentioned on the prior slide, capital markets have continued to appreciate since then, so we would expect the total plan to be even above that through mid-June. So what's driving that? The growth segment year to date is up 5.7%. Fiscal year to date is up 17%, largely driven by returns in the international equity market, as well as the large cap space. So you can see fiscal year to date, LSV kind of matching the benchmark, 14.4 versus 15.3. So pretty solid double-digit returns there. Year to date, they're essentially flat, a little bit behind the benchmark, as value has continued to kind of fall out of favor as compared to growth this year. But nonetheless, positive absolute performance in them fiscal year to date. Sustainable Growth Advisors up 17.2% versus 18.0 fiscal year to date. So strong performance for them as well. Year to date, through just 2023, they're up a little over 10%, but behind the benchmark of 15.5. So a little bit of underperformance from them, but still pretty positive performance overall. And you can just see the difference there between, the large cap value and the large cap growth. So LSV essentially kind of flat performance with SGA up, around 10%. So you can see the divergence and how much growth has kind of outperformed value so far this year. Pretty similar story in the small cap world. LSV there, year to date, down a little bit, down 3%, matching the benchmark return. And then Disciplined Growth Investors is up about 3%, just slightly behind the benchmark. So we can see, further kind of divergence between growth and value. And as I mentioned, even within the last month or the last 3 months, the small cap space has been hit particularly hard, although that's rebounded since April. But with fears of kind of an economic slowdown and recession, that tends to impact the small cap market before it impacts in the broader large cap names. So you can see that. This happened here over the last month, but as I mentioned, that's rebounded since then. And then lastly, from a growth segment perspective, lower international equity down at the bottom has really turned performance around. Year to date, they're up over 10%, getting the benchmark of 8.7, and fiscal year to date, they're up almost 26%, beating the benchmark as well. So they've been struggling a little bit over the last few quarters, but they're really kind of turning it around. Even their 1 year number up 6 versus 3, so doubled the index return over the last 1 year. So strong performance from them, and that's helping the plan, especially from a fiscal year to date perspective with that 25.7% return.
Were they ever able to sell their Russian holding they had? Did they ever?
That is a good question. I know it made up
their market has never opened it.
10 basis points of the portfolio. I'll have to check with them to see if they were able to liquidate that or not.
Right off?
They wrote it down to 0, didn't they, Cole?
They did. Yeah, they did. Look at the income segment, fiscal year to date and year to date, returning a little over 1%. And that's largely driven by the alternative credit segment, as we've seen real estate kind of come under a little bit of pressure recently. But you heard from Ares, their performance year to date up, a little over 4%, kind of matching the benchmark. Fiscal year to date, that's up 6.5 versus 8.9. So strong absolute performance from them. Long-term numbers are going to be a little bit softer, just as yields have increased so much over the last year and a half. But going forward, we really like this part of the portfolio. They're yielding almost 7% in their portfolio right now with very low duration. So forward-looking returns, we really like what's going on there. One Sharp continuing to earn very steady returns there. This is the largest piece of the alternative credit portfolio. And this is those residential kind of bridge loans that they make to kind of home builders, kind of earning that steady 6.5 to 7% each year. Very low volatility. You can see over the last 1 year they've returned 6.5%. So achieving that portfolio objectives there. LibraMax has been doing pretty well fiscal year to date. They're a little bit underneath the benchmark. If you look at longer term performance, especially that 3-year number, they're up 12% versus 5.5. So they've performed pretty well over the long term. And even year to date this year, they're up 4 versus 3% for the index. So kind of mixed performance, but overall pretty strong results.
Cole, I might just jump in there a second. I mean, I just want to emphasize that, remember, a few years ago, we refashioned the income segment to ensure that kind of every component here was well positioned to meet the long-term return expectations of the pension plan as a whole. So kind of looking to clear that 7.5+ type hurdle. And when you look at kind of results like Ares year to date, so that kind of 4.1%, that's an environment where spreads have remained pretty flat, and interest rates too, generally flat over that period. And so it's a very kind of illustrative indication of just the income returns that you can expect here, because there's very little price appreciation in that number, right? So when we're looking at kind of over the first 4 months of the year, a figure of 4%, you kind of then extrapolate that over the remainder of the year, and you end up in that kind of 8 to 9% range, which is where kind of at Jan 1 you have kind of that starting yield figure, which is a good indication of future return expectations. So you look at these figures, One Sharp's lagged a little bit, as is LibraMax, but every single kind of component here within the alternative credit sleeve is well positioned to kind of meet that 7.5% plus return target over the coming year and have that driven largely by income. And you look at the real estate segment as well. We've had discussions around the benefits of adding in those diverse exposures. So Harrison Street's core property fund as well as the social infrastructure fund, and how those are intended to provide a return profile that's relatively distinct from that more kind of cyclical return profile you see within the U.S. property fund. And that's exactly what we're seeing fiscal year to date as well as year to date, right? Where the Odyssey Index, which is that kind of office, retail, multifamily type exposure, down 9.5% fiscal year to date, down a little over 4.5% year to date, right? That's the type of stuff you're reading about in the newspaper, right? In terms of the death of office and things like that. That is not what we're holding with those Harrison Street funds, and you see the performance differences accordingly, right? Social infrastructure actually positive returns year to date, and the core property fund basically flat year to date, despite a very kind of more challenging broader real estate environment.
Yeah, great point, Zach, and compounding on that, you can see the fiscal year to date, that real estate segment's returned minus 2.5%, and the benchmark has returned minus 9.5%. So, that's led to kind of a 7% kind of alpha generation there in the portfolio from holding those diversification names.
Is the inception date when we acquired it, or is it when the fund was created?
It's when you acquired it.
We acquired it. Okay, so LibreMax isn't doing too great. I guess they must have had a good first year or so. If they're 3 years at 12%.
So, yeah, so recall LibreMax had a real terrible kind of Q3, March of 2020. So kind of right in the midst of the pandemic. And that's what we've got. So that's why you see that since inception number, that's kind of quite poor, that's kind of 0.9%. Remember, we then kind of reevaluated, re-underwrote that strategy. And then that 3-year number, that's basically from April of 2020, right? So that following month forward, right? And that's what it's done since then, right? So kind of a good decision to continue holding that allocation. But since inception, that December 18th figure still underperforming expectations. And the expectation that we have there is what their performance benchmark is, which is at cash plus 4%. But again, another strategy that's well positioned to meet the plan's return objectives on a forward-looking basis, and one that has certainly met those return expectations, since COVID. But yeah, that since inception number is a result of their performance in March of 2020.
Rough time. Anybody have any questions for WTW? Cole, Zach, do you have anything else for us?
That is it for today.
All right. Well, I hope y'all have a good day. Appreciate it.
Likewise. See you guys
Thanks,
later.
guys. Bye.
Thank you.
Bye.
All right. That's about it. We have any public comment?
Nothing I haven't already said, right?
I thought Bob said we absolutely had to.
Had to what?
That's what I heard.
Oh, from him we do.
What he did,
Um,
he won't be here for a year, okay?
Is there any further?
What does he ever do besides suck the air out?
Could he have a baby?
Is there any further member comment? The next meeting date is for August 23rd, 9 a.m. right here. We don't have a meeting in July. Motion to adjourn would be in order.
I so move. Well, I'll second.
Move.
I'll second you.
Second. All in favor? Aye.
Aye.
Any opposed? All right.
Well, here, I think you give this to Mr. Shepherd.